Hello everyone. Have you ever noticed that sometimes the amount you receive is slightly less than the amount mentioned on an invoice or payment advice? One of the main reasons for this is TDS. TDS stands for Tax Deducted at Source. It is a system introduced by the government to collect tax at the time a payment is made. Instead of collecting the entire tax at the end of the year, a small portion is collected in advance whenever certain payments are made. Let's understand this with a simple example. Suppose a consultant provides services worth 50,000 rupees to a company. As per the applicable TDS provisions, the company is required to deduct TDS at 10%. This means 5,000 rupees will be deducted as tax, and only 45,000 rupees will be paid to the consultant. The deducted 5,000 rupees is not kept by the company. It is deposited with the government on behalf of the consultant. This is how TDS works in practice. First, a vendor or service provider raises an invoice. The person making the payment checks whether TDS is applicable. If applicable, the TDS amount is calculated and deducted. The balance amount is paid to the vendor, and the deducted tax is later deposited with the government. Many people ask, who is responsible for deducting TDS? Generally, companies, partnership firms, LLPs, government departments, and certain businesses covered under tax audit provisions are required to deduct TDS while making specified payments. Another important question is when TDS should be deducted. The rule is simple. TDS must be deducted at the time of booking the expense in the accounts or at the time of making payment, whichever happens earlier. For example, if an invoice is received on 10th June and the payment is made on 25th June, but the expense is booked on 10th June itself, then TDS must be deducted on 10th June. Now let's understand the accounting treatment. Suppose professional charges amount to 50,000 rupees and TDS is 5,000 rupees. The expense account is debited by 50,000 rupees. The vendor account is credited by 45,000 rupees, and the TDS payable account is credited by 5,000 rupees. The TDS payable account is a liability account. It represents the tax amount that has been deducted from the vendor but has not yet been deposited with the government. Once the TDS amount is deposited, the TDS payable account is debited, and the bank account is credited. This clears the liability from the books of accounts. It is also important to remember the due dates. Generally, TDS deducted during a particular month should be deposited with the government on or before the 7th day of the following month. Delays can result in interest, penalties, and compliance issues. TDS provides several benefits. It ensures regular tax collection by the government, reduces tax evasion, improves transparency, and provides tax credit to the recipient. The person whose TDS has been deducted can view the credit in Form 26AS and claim the same while filing the income tax return. To summarize, TDS is tax deducted at source. It is deducted before making certain payments, deposited with the government, and reflected as tax credit for the recipient. Proper deduction, timely payment, and accurate filing of TDS returns are essential for smooth tax compliance. Thank you for watching. We hope this simple explanation helped you understand TDS and its practical application in day-to-day business transactions.